is appreciation. So what is the depreciation? It can be a month, it can be a day. For example, 2nd February. If instead it is not written, it's like 2nd February, then it is. It can also be the daily basis and can also be on monthly basis as well. So how this 0.85 negative is coming from? So this is the new value, this is old value, 1 minus t. So new value 0.697 minus old value 0.703 divided by old value 0.7703. Answer is going to be negative 0.85 in percentage or 0.0085. So it means it is currency is depreciating. So which currency is depreciating? So this is the value of which are written in terms of dollars. So that doesn't mean that the dollar is depreciating. No. Canadian dollar is depreciating right now. Here Canadian dollar is appreciating. Here Canadian dollar is appreciating. But here Canadian dollar is depreciating. Right? And this is the value of dollar, value of euro in dollars. So we have another example, value of euro in dollars. So this is the value of euro, not the value of dollar. 1 euro is equal to $1.18. See, value of dollar is, sorry, value of euro is depreciating. So if euro is depreciating, it means dollar is appreciating, vice versa. So how we are going to write this? If exchange rate of euro is depreciating here until May 1st, from January 1st to 1st May, the value is depreciating. So on that same day, the exchange rate of dollar is appreciating, because no both currencies is going to be appreciate at the same time. But here on June 1st to July 1st, euro from June to July, it means dollar is depreciating from June to July. Understand, everyone? Rujiye, Ichiye, Lancelot, Sufyan, right?
Yes, clear.
Good. So now let's come to the theoretical part here. So exchange rate equilibrium. The exchange rate represents the price of the currency, right? $1 is equal to 0.7 euros, or 1 euro is equal to $0.7. So it means it is the price of the currency at which one currency can be exchanged for another. What is the demand for currency? Demand for currency is increases when the value of the currency decreases. Recall the law of demand. If price increase, quantity decrease. Right? So if dollar price increases, demand for dollar decreases. Right? So that's why demand of dollar is downward sloping. If we talk about pound, if the price of the pound increases, quantity of the pound decreases. Which quantity? Quantity demanded. D, quantity demanded. Supply, as a supplier, what is the law of supply? If price increases, quantity supplied increases. So if pound price increases, so those who have these pounds, they want to sell at higher price. Right? So it is upward sloping. So demand is downward sloping, supply is upward sloping. So what is equilibrium? The intersection of demand and supply is called equilibrium. So in liquid spot market, what do we mean by liquid here? In which there are many buyers and many sellers. A large number of trading activities is going on. So that's why we call this liquid. A liquid spot market, at the moment when you are actually having currency exchange rates are not highly sensitive to large currency transactions. If there are many numbers and many buyers and they are just buying and selling, trading activities is at its peak, if even if a big order comes, $1 million or $1 billion, it will not affect the exchange rate of dollar, because there are many buyers and many numbers. Some are acquiring 1 million, some are acquiring 2 million, some are acquiring 50 million, some are acquiring 300 million, right? So even if 1 billion orders are coming, the price does not affect. If price affect due to 1 billion order, $1 billion order, that it means it is not liquid. Liquidity means how quickly a thing can be converted into cash. So how quickly means these are close to cash, right? If less liquid, then it takes time. When it takes time, then price can vary, right? So let's just see that. So we have market of pound. So here, market of pound, quantity of pound. What is the law of demand? If the price of pound increase, quantity of pound decrease. So if the price increase from $1.5 to $1.6, quantity of pound, those who want to buy pound, the quantity of the pound decreases. That is demand. And what is supply? Those who want to supply, if price increase from 1.5 pound or $1.5 per pound to 1.6 pound, so you see supply of pound increases. If sellers want to sell pound and buyer want to buy pound at lower prices, seller want to sell pound at higher prices. So what is equilibrium? If you make two on the same plane, we call this equilibrium. And what is the exchange rate? Exchange rate is now buyer and seller both agree on this quantity with this rate, 1.55. Right? So this is how exchange rates are determined. Any question? Oliver?
Oh,
Dancelard? Rogier? EGA? Sufyan? Okay, got your message. Okay, good. So factors that influence the exchange rate. So like in our economics class, when we talk about, there are some factors that causes shift in demand curve or shift in supply curve. So we have a new equilibrium. So the factors that affect the exchange rate, demand and supply, they are, first of all, change in inflation between the countries. So since this book is US centric, so that's why it is written US inflation with the foreign country. Number two, interest rate differential, or the difference between interest rate of two countries. Number three, income level between two countries. Number four, the government control, that how much government control the currencies, maybe levying the tariff and all those stuff. There are monetary controls and all those stuff. And the last one is change in expectations of future rates. This is not exports, these are expectations. So there are five factors that causes change in equilibrium. Number one, first of all, inflation between the countries. Number two, interest rate. Number three, income. Number four, government control. And number five, change in expectation. Now, what happened if one of the thing or all of these changes? Here we go. Factor that influence exchange rate. Number one, relative inflation. So increase in inflation leads to increase in US demand for foreign goods and increase in demand for foreign currency and increase in the exchange rate for foreign currency. Quite confusing, right? Let's just talk about that. There are two countries, US and this is, let me change the color, China. So if, as compared to China, inflation in US rises. So what happened? Which means people have more money. So demand for Chinese product demand increases. Of course, goods will flow from China to US, right? These are US investors or US buyers. They will purchase more Chinese products. But what happened here? Chinese, they require yuan. The dollar is gonna be converted into yuan. So demand for yuan rises. So what will happen here? We have equilibrium here. Supply, this is demand. Now what happened here? When demand increased, the exchange rate of yuan was here. Yuan was here, and now exchange rate of yuan is increased. We have a new equilibrium here as well. Right? So US investors are willingly to demand more yuan to convert and more yuan to pay for the Chinese product because demand for Chinese product has increased. So relative inflation causes foreign currency to increase in value. So if yuan increase, which means price of dollar decrease, depreciate, yuan will appreciate. In terms of now the terminology of international finance, yuan will appreciate, dollar will depreciate. Now let's read it again. So increase in US inflation leads to increase in the US demand for foreign products. Instead of foreign, just replace it with Chinese. Increase in US inflation leads to increase in the demand for Chinese products. Increase in US demand for Chinese currency, yuan, and increase in exchange rate for